Okay, welcome to this session at the World Congress, which is called Macro Implications of Housing. There are 4 presenters. We'll start with Brian Higgins from Stanford, who will talk about mortgage borrowing limits and house prices, evidence from a policy change in Ireland.
Great, thank you. And I'm excited to present on this paper. So in this paper, I asked the question, how do mortgage borrowing limits affect borrowing for individuals and for house prices? And in particular, I'm going to be talking about loan to income and loan to value limits that we see as part of typical mortgage contracts. And so we know that these measures of leverage increase over the business cycle, but a challenge empirically is that banks both set them endogenously and consumers choose their leverage endogenously also. So it's hard to disentangle the effect of these limits versus other shocks that change in the economy. And so this policy is going to present some new empirical evidence. We're going to use a policy change in Ireland, which changed the caps on the mortgage limits. We're going to see how that impacted borrowing and house prices. So using this policy change, I'm going to contribute in 2 halves. So in the first half of the paper, I'm going to talk about individual portfolios. And there, I'm going to point out that when a borrowing constraint binds, such that a borrower who can no longer achieve the size of mortgage that he or she would have liked to, well, they have these options. If they continue to get a mortgage, they're going to have to reduce their mortgage, and in doing so, buy a cheaper house. Or they could reduce their mortgage, but they could put up a greater down payment, and in doing so, reduce their leverage. And so then they're reducing their leverage, but they may not reduce the price that they pay as much for the house. Of course, they also have the option to no longer get a mortgage, and then they'll remain in the rental market or in the house that they had previously owned. Then in the second half of the paper, I'm going to think about equilibrium prices. And here I'm going to ask, well, if individuals buy a cheaper house, is this because they've bought a lower quality house? So they've either gone and bought a smaller apartment, or they've gone further outside of where they would like to buy? Or is it that house prices have fallen in equilibrium such that they're buying a similar house, but that the price has changed? And to preview the results, I'm going to show you that for the first half of the question, the answer is it depends. I find that poorer borrowers who were closer to being above the loan to income threshold, they buy cheaper houses, whereas richer borrowers who were initially above the loan to value threshold, they actually reduce their leverage by putting up a bigger down payment. And then in the second half, where we look at equilibrium prices, I'm going to compare across regions, and I'll show that regions where many people were above the loan to income threshold, we see a fall in the equilibrium price. And this is consistent with the first evidence that it was the people who were constrained on the loan to income threshold who had reduced their purchase price. So this paper contributes to a large literature on credit and housing. And so I just want to point out a couple things. Firstly, I think this paper contributes by focusing on a policy change where the limits were tightened by the central bank as opposed to banks or consumers. And also that I point out some of the differences between the loan to income constraints and the loan to value constraints, and in particular how people can respond to them. I also contribute to a large literature on macroprudential policy and both whether and how much we should constrain these sorts of leverage decisions. And in this, I contribute by providing some evidence from the implementation of one such borrower-based macroprudential policy. So before jumping into the literature, I just want to pause for a moment and highlight one of the key differences between the loan to value and the loan to income constraints. So here is the problem of a typical owner household who's maximizing lifetime utility, subject to a budget constraint where they can choose to consume, to save, to borrow in a mortgage, or to buy a house. And then we have the loan to value and the loan to income constraints. So the loan to value constrains the size of the mortgage relative to the size of the house, or put in another way, you have to put a fixed fraction of the house value down in cash savings, versus the loan to income, which is constraining relative to your current income, so a fixed multiple of your current income. So we can point out that the loan to value constraint binds when cash on hand is low relative to the house price that you would like to, or the house size that you would like to achieve. But more savings allows more borrowing. So if you have a 90% LTV, for example, then $1 in more savings allows you to borrow $9 more. On the other hand, with the loan to income constraint, it's binding if your income is low relative to the optimal house price value. But here, savings does not allow more borrowing. So you can save away from the constraint, and an extra dollar allows you to buy an extra dollar of a house price, but it doesn't allow you to borrow against that saving. And so that's an important feature that we see in the difference between these constraints, and I think that's going to be important when we get through to the results. So before jumping into the data, I'll give you a little bit of background on the policy change. So as I'm sure many of you are aware, Ireland had a large boom and bust in the 2000s, where house prices went up about threefold and then fell 50% after the financial crisis. And during this time, there was a lot of default on mortgages. Ultimately, the banks were bailed out by the government, and the government was bailed out by international institutions. And it was within this context that the central bank brought in this policy change with the explicit idea of limiting such kind of boom-bust cycles. The policy was introduced in 2015, which is about 18 months from the bottom of the house price cycle, and GDP had been growing a little bit before that. So prices are growing during this time. And then I have some evidence in the paper that this is an unanticipated policy change. So I do this with some Google Trends analysis. And it looks like borrowers were not aware that this policy was coming in place. And so I don't think that their previous decisions before the policy were affected by it. So let's look at what the actual policies were. So there were loan to income and loan to value constraints put in at the same time. So the loan to value applied differently to first-time buyers, second-time buyers, and investors. So first-time buyers had a 10% down payment. If you had previously had a mortgage, then you had to put a higher down payment of 20%. And then if you were buying a mortgage with the explicit intention of renting it out, you had to put an even larger down payment down. Then on the loan to income constraint, this applied to the first two categories. So non-investor households could only borrow up to 3.5 times their income. And then I'll talk in the next couple of slides about whether we think these constraints are binding relative to before and after. There's a couple more details on the first-time buyers that I deal with in the paper. For the first 2 years, there was a sliding scale where they had to put an extra down payment if they bought a particularly expensive house. But for our purposes today, I think it's sufficient to know these rules. There were a few exemptions. So one exemption is that banks were allowed to exceed the limit in 20% of new lending. And this was a choice of the bank to give a little bit of flexibility to the rule. And then it also only applied to houses that were being used for a new house purchase. So if you were refinancing or restructuring a mortgage for a house that was previously bought, then that was exempt. And this is important because in Ireland, you typically have a 3 to 5 year fixed mortgage that goes on to a variable rate. And after the end of the variable rate, you may refinance back to a fixed rate. So you may refinance multiple times throughout your mortgage, even if interest rates have not necessarily moved in your favor. So next I want to talk about the impact of the policy on borrowing. And so to do so, I'm going to build an individual data set that comes from the Central Bank of Ireland. And in this data set, we can observe the pieces of the mortgage contract. So the purchase price of the house, the mortgage, the deposit and the income, all at origination, with which we can compute the loan to value and the loan to income. And this is going to include, this data set includes all mortgages, although I'm going to restrict attention. I'm going to exclude one large bank that didn't report their income before the policy change. so that it's difficult to compute the loan to income in that case. And so the question I'm going to ask here, at least initially, is how do these 2015 limits compare to the distributions that we saw in the previous years? So here I plot the density of new mortgages by loan to income and year, and I'm going to plot them for 3 years. I plot for 2006 because this is the peak of the last house price boom in Ireland. Then 2014 is the year before the policy change occurred. And in 2018 is our most recent full year of data. And so what we can see is that in 2006, the limit of 3.5 would have been constraining on a large fraction of the mortgages that were issued in that year. When we come to 2014, again, this is closer to the bottom of the house price cycle, and the distribution is pushed to the left. So there's not a large fraction of mortgages that were constrained in the year prior to the policy change. Although in the years following, the distribution moves considerably to the right. And we see that by 2018, there is a large fraction of mortgage holders who are constrained. So there's above 20% of people are exactly at the 3.5 mark. And the distribution is running closer and higher as we get closer to the cutoff point. As I pointed out before, there are exemptions, so that explains the little bit of mass that we see above the 3.5 mark, as banks can still give a little bit extra. There are similar patterns for LTV in terms of the timing being constrained in 2006 and also in 2018, and I'll look at those in more detail in the paper. So next I want to compare choices across time. And so to do so, I'm going to construct a panel. So this data set is a repeated cross-section of mortgages where we don't observe people purchasing houses in more than 1 year. So to compare choices across time, I'm going to group these mortgage holders into observable characteristics. And I'm going to do so with 7 age bins, 10 income buckets, and then 2 buyer types. Those buyer types being whether you are a first-time buyer or a second-time buyer. When we construct these averages, the mean LTV or LTI of these groups definitely differs, but we don't have many of these groups that are actually above the threshold on average. And so it's hard to define like a treated group within these groups. So I'm going to compute the percentage of people who are above the threshold in each cell in 2014. And this will be my measure of how quote unquote treated this group is, or how close to being constrained this group of borrowers are. Within each cell, then I can compute the average purchase price, mortgage and deposit. And then in the spirit of the labor literature that used a lot of these kind of grouping estimators, I'm going to weight the results by cell size. And then in what follows, I'm going to ask firstly, well, what groups were above the threshold in the pre-period? And then secondly, I'll ask how did the choices of these groups, in particular their purchase price and their leverage decision, which at the very beginning I said is the sort of core trade-off for someone who's constrained by one of these limits, how do those choices change after the policy? So in this plot, I ask who was above the threshold. So each circle is going to be one of these cells that I said. So this could be the group that are earning 25,000 euro and are below the age of 30, say. And then the size of the circle tells you how big the group is. And I plot the income of the group versus the percentage of people who were above the LTI threshold in the year before the policy. And so we see a negative relationship in that the people who are more likely to be above the loan to income threshold are more likely to be a lot lower income. We can do the same graph for loan to value, again plotting income against the percentage of people above the loan to value threshold before the policy. And here we see the opposite case, that actually the people who are above the loan to value threshold were higher income. We can check this against multiple other covariates. So we see that the loan to income threshold was binding on groups that were poorer and younger. And I also check against the ECB's household finance and consumption survey around the same time. And these groups were also had lower wealth. Whereas on the loan to value threshold, these groups tended to be richer. There's not much correlation in age, and they had more wealth. So next, we want to ask, well, how did these groups change over time? And I'm going to do so in a difference in difference event study regression, where the outcome is going to be the purchase price or their loan to value decision. I'm going to include time fixed effects and individual cell fixed effects so that we can control for, or well, we will be comparing differential trends across the groups. And then I'm going to include two treatment intensity variables, which are the percentage of people above the loan to income threshold and the percentage of people above the loan to value threshold, both in the pre-year in 2014. So this is going to tell us how the slope of these variables related to the purchase price and the loan to value. I'm going to interact these over time so that we're going to get this slope and see how it changes over time, dropping the pre-year, which is 2014. So these are the results of that regression. So I'm going to plot the coefficients for the delta Ks for the loan to income. And we see that, you know, the pre-trend is flat, and if anything, it was increasing in the previous year. And the coefficient on the 2015 on the 2015 value implies that 1 percentage point more higher people above the LTI threshold in the year before the policy implies a 0.5% decline in the purchase price in the year after the policy. So if we compare the groups that we sort of the spread on the groups in the scatter plots, we find a 15% lower price in 2015 for cells or groups who had 30% of people above the LTI threshold versus those who had none above the LTI threshold. Next, we can compare their leverage decisions. And so here we see that their leverage has not really declined. Depending on what you want to think about the pre-trends, either the trend has kind of continued or the leverage has increased. This might be a little bit puzzling, but this is that these groups who were close to the loan to income threshold, they did reduce their purchase price, but they may have also reduced their down payment, and so that their leverage has increased. So that's the results on the loan to income groups. For the loan to value groups, I include, so I think it's worth looking here at the leverage choice first. We see the pre-trend was increasing, but we see after the policy change, the leverage of these groups significantly fell, which implies that for a given house price, they've put up a larger down payment. And so they've adjusted by putting up larger down payments as opposed to reducing their purchase price. And as we see, the purchase price is, if anything, slightly increased, although again, depending on your interpretation of these pre-trends, the purchase price may have kind of been unchanged or slightly lower. Again, the magnitudes are quite large. So if we compare sort of the spread on the loan to value threshold, we find a 25 percentage point lower LTV in 2015 for cells with 50% above the loan to value threshold versus those with 0%. So I think at this point it's worth stopping, and we see that we've seen that these groups differ both in terms of the resources available to them, and then we see that the loan to value groups mostly adjust through decreasing their leverage, whereas the loan to income groups adjusted by decreasing their purchase price. In all of these are regressions, I've included both treatment intensities in the same regression, although we could have done this in sequential or in two regressions, and the results are broadly similar. Okay, so I've shown you the results for individual choices of purchases. Next, I'm going to talk about equilibrium prices. And so to do so, I plot, I construct a regional data set. And so this regional data set is of postcodes within Ireland. So we have 25 counties, and then because Dublin is the biggest city, I'm actually going to go into the postcodes of Dublin. And within each county or postcode, we have the average price and rent indices from Daft, which is a website very close to Zillow. And then within each county, I'm going to construct a similar measure. So this is for the geographical area as opposed to a group. I'm going to construct the percentage who are above the threshold in 2014, the year prior to the policy. And then unfortunately, because of some data limitations, I limit myself to 2 banks within Dublin. And the question here is, how did equilibrium prices change? And I'm going to do so using the same empirical specification as before. So here I plot the results of the delta Ks for the loan to income and the loan to value. And if we look at the left-hand side, we see that in areas that were high on the loan to income constraint, in the about 10 quarters before, there were no differential trends in price growth in these regions. And then in the months after the policy, these regions saw their price to rent ratio decline relative to the regions that had low LTI ratios. And next, if we look at the loan to value, we see that this is not the case. So these groups that were high or the regions that were high on the loan to value ratio were increasing faster before the policy, and they continue to increase faster, although maybe a little bit below the trend. And so this is where my result that I said at the beginning is that we see equilibrium prices change in areas where the loan to income threshold, where lots of people were above the loan to income threshold, but not so much with the loan to value threshold. And this is consistent with the results from the individual borrowers that we see that it was also those groups who reduced the purchase price they paid. Okay, so there are a couple lessons that I think are takeaways from this paper. One is that the impact of these sorts of policies on borrowing, it depends on what groups and what policies you have. So I find that groups that were high on loan to income, above the loan to income threshold, they mostly decrease their purchase price in reaction to being constrained. Whereas groups who are constrained on the loan to value threshold mostly decrease their leverage, and the magnitudes are large. Then to kind of point out why this might be the case, I've pointed out that these constraints act in different ways, but also that the loan to value and the loan to income groups differ both in terms of their net worth and their income. And then when looking at the impact of the policy on house prices in aggregate, I compare across regions. And consistent with the first results, I find that the price to rent ratio fell in areas where people were more likely to be above the loan to income threshold. And lastly, I just point out that in ongoing work, I'm working to explain these results in a quantitative life cycle model. There we can think about how these policy changes work in 2 ways. One is that they change the decision rules or the policy functions of the agents within the model. And 2, the reactions may differ depending on where in the state space you are, as we've shown that the different groups differed substantially in where in the state space they would have been. And so that's the result of my paper, and so I'm excited to hear your questions and to see all the rest of the papers from this session.
Thank you, Brian. Very interesting. So please, Kaiji and Dennis, would you like to start? And I'll also have a couple of questions. So.
Yeah, so question, here's a policy difference for the first time and the second time home buyer or investor. I wonder whether there is systematic difference across this group of household for the loan to income ratio or loan to value ratio. Is that the second time buyer or the investor, they probably have a higher loan to value ratio. So that could help us to understand what the motive for purchasing the house, whether there's just you move from rental market to the housing market, or you are going to trade up your housing size, or you just want to purchase a house for investment? Yeah.
Yeah, so I think that's a good question. And I think, yeah, so I think for the loan to income, I do think it's more binding on the first time buyers. And then, yeah, my suspicion is that some of the people who are less constrained on the LTV may have been selling houses, but I think that's something that I can definitely look into a lot more and check those features in the data. I think it's definitely important for the policy, and we saw that the policy was had these kind of higher constraints on the second time buyers, in that they had to put a 20% down payment. So that could be explaining why we see in the pre-period that these kind of look higher on the loan to value ratio. So I think they're good points to make.
So I also have a question, and this kind of builds up a bit on Kaiji's question. So it's about the guys that were buying as an investment. So they have a new LTV of 30%, and I think, at least, you know, judging by what happens in other markets, it seems to me that these people typically buy houses in poorer areas that they rent out to what you call the high LTI groups. So if the high LTI groups don't qualify for a mortgage after the reform, it could also be that they will need more rentals, but rentals are less available because the investors are getting also hit by the LTV. So I was wondering, maybe you can exploit this differential by how many investors are in certain areas. Maybe there's more in the PTI areas, and then you can, the LTI areas, and then you can disentangle sort of, this is how LTI contributes, and this is how this sort of supply of rentals or supply of housing part contributes, coming from the people that suddenly get higher LTVs on their investments.
Yeah, I think that's definitely a good way to approach it. I think there's a couple ways to think about this, and one is that for new rentals that are coming on stream, it depends on whether you think they are being bought by individuals who get a mortgage, or whether they're being bought by institutional buyers who might kind of build a lot of rentals. But I think even looking at institutional buyers, but also, yeah, this the number of people who were getting rentals in particular regions, I think that's definitely something to look into, and it can explain some of the results on rentals. Yeah.
Okay, I have a quick question also. So this the price rent ratio. So why do you use that? Is that because of like just data limitations?
So
rather than like splitting it to look at kind of what happens to prices to buy versus prices to rent?
Yeah, so there's two reasons. The results don't really change. So if I do this on prices, the same patterns happen in prices. The reason I did it on prices to rent is that actually, if we just look in the aggregate, around this time, the price to rent ratio falls in Ireland, despite the fact that both prices are increasing and rents are increasing. So I didn't show it today, but it's kind of an interesting fact that in the aggregate, we see that the price to rent ratio falls after the policy. And so then when I look at the cross section, lots of my results are sort of done with that variable as well. But we do see that it looks like it's the price changes in the cross section as opposed to the rental market being really affected in the cross section. But that's a good question.
Great. Thank you.
Great,
okay.
Thank you.
Any other questions? Okay, so let's move on. Thank you, Brian, so much. So now we'll have Kaiji Chen from Emory University, and he will present. Wait, where is it? Yeah. Kaiji, okay, yeah. He'll present on aggregate and distributional impacts of housing policy, China's experiment. So.
All right, very good. Okay, so our paper is related to two general issues surrounding the housing boom and bust. The first one is how does the relaxation of loan-to-value ratio limit for mortgage loan transmit into the housing boom? The second one is what are the distributional impact of such policy change across household of different characteristics, for example, age and education level. So in this paper, we're going to take China's recent policy change as an experiment to address these two issues. This is because unlike the US, the recent LTV policy change in China was extraordinary in magnitude and was unanticipated. Therefore, this policy can serve an ideal experiment to isolate the exogenous change in credit condition. And we can explore how that can affect the housing boom. Okay, so what a China's experiment. So in order to resolve this overstock housing after the 2009 economic stimulus, the China relaxed its LTV policy between 2014 Q4 and 2016 Q3. The purpose of this relaxation of policy is to encourage rich households to go to the housing market to buy the housing stocks, which help to reduce the overstock housing. As a result, here for the primary house, which in this paper we call first house, the minimum down payment ratio decreased from 30 to 20%, which is not that much. By contrast, for the non-primary house, which is we call it secondary house, the minimum down payment ratio decreased from 60 to 70% to 30%. So that's a big decrease. As a result, there is a mortgage credit housing market boom during this period. And the average annual newly issued mortgage amount is 92% higher than its counterpart in the pre-policy period. So in this chart, I'm gonna show you on the top left is the average loan-to-value ratio at origination. And here, the red line is the LTV ratio for the non-primary house. The blue line is the LTV ratio for the primary house. And the window between these two dashed lines is the policy relaxation period. And you can see that during this period, the LTV ratio for the non-primary house has jumped up tremendously. And in contrast to a very mild increased LTV ratio for the primary house. And also total mortgage has increased in terms of both amount and number. Housing price has increased also during this period with the annual housing price increased by 5.6%. Very interestingly, we find that during this period, the real consumption per capita has actually declined relative to the pre-policy period. Okay? And this is more so when the policy is reversed. Okay, so in this paper, we're gonna ask the following question. What is the aggregate and distributional impact of this policy change on the mortgage, housing demand, and household consumption? So we're gonna address this issue from both empirical and theoretical perspective. Empirically, we're gonna use the two micro-level data and build on the facts, we're gonna build an OG model with household heterogeneity. So here's a pre-review of the main result. Empirically, we find that the relaxation of this LTV limit reallocates mortgage credit toward middle-aged, high-educated household, while squeezing out those to the young household. Here, by using education, we're proxy for the permanent income level, because from the literature of this house mortgage, we know that when you, as a mortgager, they tend to self-report their income. So that's why we use the education as a proxy for their income, permanent income. And also we find that the same group of households are also the main driver of the slowdown in average consumption growth. So, and to explain those facts, we build a theory, and our model uncover a novel channel for the change in LTV ratio to affect the housing demand. In particular, we find that increase in the maximum LTV ratio for the non-primary house going to involve a self-reinforcing effect on housing demand through the equilibrium housing price, which is very similar spirit to Jeremy Stein's 1995 papers. So what is the mechanism looks like? So initially, there is a relaxation of the LTV policy for the non-primary house. So if households have a strong belief about the future housing demand, so that's gonna trigger an increase in the housing demand for the non-primary house, but for the investment purpose. As a result, the housing price is going to increase, but the increase in housing price is also going to spill over to the market on the private house. So that's going to imply a capital gain for the existing homeowner before the policy has been relaxed. And if this household, they also have a strong belief about the future housing demand, they're going to trade up or upsizing their house. So that's going to trigger another round of increasing the housing demand and the housing price. So this is the self-reinforcing mechanism that we mentioned. And that means that the higher housing price and the higher housing demand going to reinforce each other. And we found that this channel is quantitatively important to explain the housing price and the mortgage increase. Okay, so we're going to talk briefly about the data, evidence, and the theory. Our data are coming from two sides. One is the proprietary mortgage origination data, and which is coming from one of the biggest commercial banks in China. And these banks' outstanding mortgage loan account for about 14% of total outstanding mortgage loan. And so very important information about this data set that it contains information on whether the mortgage is used to purchase the primary or non-primary house. And in China, all the mortgage is to purchase the house. There's no more refinancing or home equity loan or credit. The other data set is the China's Household Finance Survey. It's the most comprehensive household survey in China, and it's a combination of version of the CEX and SCF. And in particular, it contains information on both asset liability and the expenditure side. So it helps us to build a linkage between your consumption growth and your mortgage debt burden. Okay, so what are the evidence we find? First of all, we show how the distribution of the LTV ratio has been evolved. And this is going to help us to understand to what extent household kind of borrowing constraint. So here on the left panel, we show the primary house, and the right panel is the non-primary house. And we picked the 90 percentile, 75 percentile, median, and the bottom 25 percentile in terms of LTV ratio. And here we can see that on the left panels, except for the bottom 25 percentile, essentially all the other household LTV ratio is close or at is the LTV limit. Okay, and the same pattern holds for the non-primary house. And now essentially all the household who are mortgager, their LTV ratio is close to the LTV limit before the policy got relaxed. And when policy relaxed, and most households, their LTV ratio actually got increased. That implies that they do take advantage of taking a policy to leverage against their housing position. Okay, so here we're going to show the time series mortgage amount and the debt burden. In this chart, we have two lines. The red line is the mortgage for the all house, including the primary house and the non-primary house. And here on the top left panel, we see that these two lines track each other very closely. And this is because the mortgage for the non-primary house is a very small part of the total mortgage. Before the policy got relaxed, it's only 5%. When during the policy relaxation period, we see that these two lines diverge a little bit, which means that the share of the secondary house mortgage has increased. However, the main driver of the increase in the total mortgage still coming from the increase in the mortgage for the primary house. That does suggest that relaxation of the LTV ratio limits for the non-primary house has a spillover effect onto the mortgage demand in the primary house. The bottom two panels shows the mortgage debt to income ratio at the origination and house value to income ratio. And here we see that during the policy boom period, again, both ratio has increased. And to just give you an idea of the magnitude in the US during 2001 and 6, according to Nenov, even the bottom income rate below 3 ratio is much higher. Okay, so now we're going to show the change in the mortgage share by age and education. We group household into 6 age education categories. below 30, which we call the young, 30 to 50, middle age, above 50 is old age, and high school and below and college above. And here we see that during this boom period, the only group of household that gained significantly the mortgage share is the middle-aged, high-educated household. This is hold true for both the amount share and the number of shares. And so what drives the increase in the mortgage? According to our story, is that those existing homeowners, they're gonna upside their house, okay? So in order to see whether this is true in the data, we compute the average housing value for the primary house along the age profile. And in order to control the effect of housing price inflation on the average housing value, we're gonna deflate the average housing value by the constant quality housing price of each city that the mortgager is reside at the time when the mortgage happened. Okay. So the left panel shows the low educated average housing value. We see that throughout all the 3 years, 11, 13, and 15, this the change in the average housing value across the age is kind of symmetric. 11 and 13 is before the policy got relaxed. 15 is when the policy is relaxed. By contrast, on the right panel, we see that, well, in 11, 13, still the change in the average housing value is kind of symmetric across all different age groups. But when it comes to 15, we see that the middle-aged, high-educated household housing value has been increased significantly. And notice that this housing value is controlled by housing price. So that does suggest that middle-aged household, their housing size or quality has gone up tremendously during the boom period. All right, so now we're gonna move to the non-housing consumption growth by age and education. So here we see that in terms of consumption growth, here we have two periods. One is 13 and 15, which is before the policy got relaxed. 15 and 17, when during the policy boom, we see that, again, the only group of households that experience a significant decline in consumption growth is the middle-aged, high-educated household. This is despite that their income growth actually speed up, okay? So, that is something in contrast to the existing literature where they find that consumption growth typically speed up during the housing boom. And in our paper, we also run the regression to link consumption growth with more debt burden, and we find that households who are more heavily debt burden actually have a lower consumption growth. Everything else the same. Okay, so now we move on to the theory. Okay, so our model framework is a multi-period OG model with household heterogeneity. There are two crucial ingredients in our model. The first one is that the primary and the secondary house are subject to different minimum down payment ratio. And by this, we try to isolate the channel that the change in the LTV ratio affects the mortgage demand through the equilibrium housing price, and which we showed that it's a crucial channel in our model to drive the change in the mortgage demand. The second, the crucial ingredient is that household utility on housing surveys going to contains two stochastic regime, which capture belief about future housing demand. So this is kind of in the same spirit of Kaplan, Mittman, and Violante paper, and to use this trick to capture belief about the future housing demand. And it's just a simple way to model the rational bubble while still allow the housing investor to enjoy housing services. So as a result, in our model, that there are two types of households that are financial constrained. Okay, one group household is the young guy and especially the poor guy who are constrained for housing consumption purpose. And the other group of household that are constrained is the middle-aged, high-educated household that are constrained for housing investment purpose. Okay. Okay, so the household utility is standard. It's a kind of CES a utility function. And here, Yeah, thanks. Yeah.
Okay, so we are back. So
Okay.
minor technical problem. Yes.
Yeah. So this utility is a CEX, and here the phi, which is a utility for the housing service, is stochastic. And in order to capture the lifetime wells, we have this warm globe bequest model. And in particular, this phi K2 value, one is a low and the other one is high. And at the initial steady state, we assume our house will have sitting in the low value, but there is a probability that the phi is going to switch to the high state. And by using this, we capture the belief about future demand. Different from capitalism Violante, that throughout of transition period, we do not allow this phi to change. In other words, the only driver of this change is the policy. And the total holding size is H, and here there is a threshold H hat for the primary and the non-primary house. If your holding size is below the H hat, your primary one, and above that, it's a non-primary one. And the non-primary one does not have any utility. Okay, so here the house will have a two permanent income group to be able to match the data, and there idiosyncratic uninsurable income shocks and within each period. So if this period, this household may have a low shock, they choose not to upside, but when they have a high shock, it may choose to upside their home. Okay, and for simplicity, the retirement income is just a fraction of the income at the last period working age, saving risk-free bond, no borrowing except for mortgage. Housing can be bought at a price, can be PH or rent at the row edge. Housing status, beginner period, you either have a house, you don't have a house. You can choose to, if you don't have a house, you can rent, you can purchase. If you have a house, you can either sell, pay. When you sell, you can rent or buy. We assume age-dependent fixed moving costs in order to match the mortgage share at the steady state. The mortgage is a long-term mortgage. In China, there's no refinance, so we have that. Here there's a home equity loan, no home equity loan credit, non-defaultable, adjustable mortgage rate, fixed mortgage origination cost, and the minimum mortgage payment each period following constant amortization over the remaining lifetime. So here, the maximum LTV ratio depend on whether the house is a primary one or the non-primary one. For the primary one, it's lambda 1. Non-primary one is lambda 2. Okay, so the remaining of the model is quite standard. So for the time being, I'm just skipping that. Okay. And okay, in terms of calibration, we calibrate the initial steady state model to match the key aggregate and cross-sectional moment before the relaxation of the LTV policy in 2014 Q4. Each period corresponds to a 2 years. So because in the reality, the policy relaxation is just 2-year window. So here it's just a temporary shocks. And we calibrate the model to match the various moment, and most of which are quite standard with the literature. Here, one of the things I want to highlight is that we calibrate the owner housing grid in order to match the housing wealth to net wealth ratio distribution. And we pick the bottom 10 percentile, median, and the top 10 percentile to calibrate the 3 moments: the minimum housing grid, and the number of grid, and the distance of the grid. Okay. And here is the target moment, and we can see the model and the data did a pretty recent jobs. This is the on-target moment, and we see that our model also doing reasonably well. Okay, so what are the baseline policy experiment? So in the initial steady state, we assume that there is there's a policy change. In period 1, there's a higher maximum LTV rate for secondary house. So that's a kind of MIT shot. In other words, it's increased from 0.3 to 0.7 unexpectedly. Household expect this new policy gonna last forever. In period 2, this policy going to reverse back to the initial steady state. And also this level going to maintain throughout the rest of transition period and the new steady state. Okay, so this is our main result. So at every level, we do see that our model can explain about 70% of the increase in the housing price. and almost all the increase in the mortgage amount, and about 65% of the increase in the mortgage number. Also, our model can do reasonably well to capture the change of the mortgage amount for the primary house, which is the main driver of this housing boom. This is despite the fact that the change in the LTV ratio is only on the non-primary house. On the other hand, our model overpredict the drop in consumption growth. So this is the model's prediction on the distributional side. Here, we show that consistent with the data, the model predicts that the only group of households that experience a significant increase in the mortgage share is the middle-aged, high-educated household. And while this household also decrease their consumption growth. So who are the guys that responsible for the increase of the mortgage demand? And so in the model, remember there are two groups of households. One is that household that can move from the renter to the housing market. That's the extensive margin. The other margin is more intensive in the sense that existing homeowners, they can trade up their housing, right? So in the steady state, we expect that only high productivity guy will do so. But when the policy got relaxed and there the household who experience even low productivity, they can also enjoy this chance to churn out. So we're going to compute the contribution of the net increase in churn out to the housing boom. And this we found is very important. So they can explain about half of the increase in the mortgage amount. Almost 90% of the increase in the mortgage number and more than half of the increase in the housing demand. And among those households who choose to churn up in the transition, but not in the steady state, we found that the household that are mainly responsible is the middle-aged, high-educated household. Okay. So what's the role of the increase in the housing price in our model? So to understand this, we conduct a counterfactual policy experiment in the sense that we hold the housing price to be constant at the steady state level and only let the second house LT policy to change. And we show that here, in contrast to a benchmark result, now the increase of the mortgage amount and number become much smaller. And because this is purely driven by the increase in the mortgage for the secondary house, which is under the direct impact of this policy. And also the change in the mortgage amount and the numbers for the primary house now become negative. So that does suggest that the increase in the housing price is the main driver for the change in the mortgage for the primary house. And also here we show that if you hold the housing price as constant, here the middle-aged, high-educated mortgage share actually got declined. All right, so now we're going to go back to the initial slide that we talked about. After the policy is over, we still observe the consumption growth slowdown, despite the transitory nature of the policy. Here, we can also see that the model can capture that. So despite that the policy relaxation only lasts for one period, here we see that the consumption of the middle-aged, high-educated household at the beginning of transition, the consumption is going to go down on impact, but keep going down when the policy is over. And this consumption growth down is persistent. And why that? Because housing is illiquid. When they purchase those houses at the initial period of the transition, and even if later on policy got reversed, it's hard for them to sell the housing. And instead, they have to service their mortgage debt. So here we can see that the debt to income ratio only go back to the initial steady state very slowly. Okay, we also compute the welfare implication, and here I'm just skip that. Just to conclude, we find that empirically, a relaxation of this policy has significant aggregate and distributional impact. And in the sense that it stimulates the mortgage loan by the middle-aged, high-educated household at the sacrifice of the young household. And this household also reduce the consumption growth. And then we build an OG model with household heterogeneity. And we show that our model contains a novel channel for the changing credit condition to affect household demand and through equilibrium housing price. And this policy is quantitatively important for the increase in the housing price. And also, this policy is going to generate unintended welfare loss, especially for those low-educated young households by crowding them out on the housing market. Yeah, thank you.
Thank you. Okay, so now we're gonna have a round of questions. Maybe I'll start this time. Very interesting and very nice combination of both data and theory. So my only question was, it's very interesting, this consumption decline, and it's very nice that your model matches it. But I was just thinking about the US housing boom, and there were like one saw like a consumption boom associated with it. So is it something to do with like the different structure of the mortgage financing that would kind of explain the differences that people can kind of use the housing wealth?
Yeah, that's a very good point. And of course, in China, there is no refinancing or home equity loan credit. So that means that when housing price increase, you cannot just tap the housing equity. But also, we find that the policy also matters. When we experiment the model with the LTV ratio limit change for the private house, we do find that the middle-aged, high-educated household consumption actually increase. And this is very intuitive in the sense that for the non-private house, because LTV ratio change. Remember that there for the private house, this LTV ratio is still the same, right? So even if they enjoy the capital gain, when they choose to trade up their housing, they still are willing to sacrifice their today's consumption growth in order to buy a bigger house because they cannot borrow more against their housing value, right? However, when your LTV ratio limit for the private house got relaxed, now they can enjoy more consumption. So the policy also matters. Yeah.
I understand. Okay, thank you. Dennis and Brian, do you have any questions?
Yeah, I have a question. So since I work for a policy institution, I'm going to ask a policy question, kinda. So it's and it builds a bit on Plamen's question in the sense that I'm going to ask a question about the refinancing part. So if these people were allowed to borrow out of the sort of to cash out refinance out of the gain in their secondary home prices, then you wouldn't see such a drop in consumption. And then the question would be, in your model, can you actually design an experiment where you allow this option of cash out refinancing, and can you compute some sort of what would be the appropriate LTV ratio that they can go up to, so that the welfare losses that you compute are nullified? Because I suspect there at some point in time China will start allowing people to cash out refinance. So that would be great. That would be just, you would throw a number at the policymakers in China. This is what you need to do, guys.
I would definitely do that. Yeah, I think that's a very good suggestion. In terms of what kind of policy can make people happy. That's not just sacrifice their consumption, right? So I would definitely do that. Yeah, I think that's a great suggestion. Yeah.
Brian, any question?
I had a question that there are two PhD students at Stanford who pointed out that in China, there's a big tradition of buying a second house for a member of your family when they're going to get married. And so I was wondering, do you know how much of these second purchases are for investment, or how much of them are actually staying in the household? And that might be important for some of your welfare implications, where you say it's kind of middle-aged who buy the house at the detriment of the younger. But if it's within the same household, that might not be the case. And I'm just wondering if you had any thoughts. Right.
Yeah, I think this is a very relevant question, and we always think about that because yeah, that's true. But also that's in the data, it's hard to see that because this is just a mortgage data. They did not tell whether I purchased this house
Yeah.
for my kids, or that's just an investment. But my sense is that even if you purchase a house for your kids, right? And so this is still kind of like an investment. You can choose to save in the bank account, right? And then that's later on you take out the money for your kids to pay the down payment. But instead you choose to purchase a house for your kid. That means that the housing value actually going to increase in the future. So that makes you to feel that housing investment is a better option than just save in the bank account. So we still view that as a kind of investment. Of course, later on, when you cash that investment out, whether you just use for yourself or you use for your kid. So in that sense, we actually, our model, roughly capture that. We don't model exactly the household with a transfer, but we have this one group bequest model. This is somehow,
Okay.
capture that. Yeah.
Yeah. Great. Thank you.
Yeah. Thank you. Yeah.
Okay. Thank you, Kaiji.
Yeah.
So now we're going to move to Dennis Gore from the National Bank of Denmark. Okay, Dennis, we'll talk about house price responses to monetary policy surprises, evidence from housing listing data.
Yes,
Please.
so we talked a bit about the payment to income constraint. We talked about the LTV constraint. So now let's talk about the interest rates, which also affect or should affect housing prices. This is joint work with Alexia and Mariana, and the views are our own and not necessarily of our employers. So what we do in this paper is we try to answer a very simple question, namely, do house prices react to changes in interest rates? And we do so, we answer this question using daily data on housing listings and sales. And we focus on episodes around monetary policy announcements. So the way it works at most central banks is that there are fixed windows in which central banks decide on their announcements. So we will use those fixed windows to try to nail down the price response if there is one. And we'll also study the role of information networks, which we hope can influence the response in prices. So you should think of how real estate agents and mortgage bankers affect the response of listed prices when interest rate changes. And I'll be more explicit about the exact information networks that we use in our paper. And sort of to preview the results, we find that yes, list prices respond promptly in weeks after announcements, but not so much after 2008. So if you think about the past 10 years, there's not much that changes in interest rates. Well, at least we cannot identify much of an influence of changes in interest rates on changes in house prices. And the response seems to depend a lot on the information channel. So on links that sellers and buyers have with their real estate brokers and with their mortgage brokers. Both the promptness of the response and sort of the size of the response in house prices. So just to give you a bit of a background on where this literature stands, so far it has been mostly a macro-ish type of literature in the sense that people have run primarily VARs on quarterly or monthly house price index data, and then they regress that on interest rate changes. And what they find is that the effects materialize after about 2 years. So if you find any significant response, it's in 1/2 years, and typically the response is around 6%. So for a 1 percentage point increase in short-term rates, you would find a 6% decrease in house prices. Okay, and we kind of thought about this set of results, and we asked ourselves, so we know that housing transactions have many intermediaries, and the most obvious one would be the real estate brokers or real estate agents. We also know that these intermediaries know more about the state of the market because they monitor it daily, and then they have an idea of how many entries and exits are in the market. And we also know that these agents facilitate in some countries the interaction between buyers and sellers and mortgage bankers, all right? So akin to financial transactions, information should spread really fast in the housing market. So if, let's say, the central bank changes the interest rate today, it's very likely that the real estate broker will already tell the next buyer / seller that he sees that, look, you should expect more or less demand in the housing market because suddenly the interest rate is lower or higher. So this is what we're going to do here. We're going to take a high frequency event study approach to listings data, and we are going to identify determinants of potential price effects. So the data that we use is going to be Canadian data. It will be all the universe of all listings and sales from Vancouver. It will be daily data between January 2000 and May 2015, where we have basically whatever you see when you see a listing online. We have all that data, including some data that you don't see there, namely information on real estate agents intermediating the transaction. So we know how large these agents are, we know their professional histories, and so on. And in terms of the house price data, in terms of the house data, you will see everything starting from the list price and list date, and ending with the sale price and sale date, and as well as all the property characteristics that are there. And so if some houses have fancy kitchens or swimming pools, we will also see that. All right, so we're going to proxy for monetary policy shocks in various ways. So the literature up to now has focused on sort of changes before and after announcement in futures prices. So if you think about the US data, that's what typically people do. The unfortunate part about the Canadian data is that we only have this futures data starting later on in our sample. So we are going to rely on actually another measure of monetary policy shocks, namely changes in treasury bills and bonds before and after the announcement. All right, so think of anything that was not anticipated in the treasury market when it comes to a change in interest rate should be captured by this change in yields for zero coupon bonds. And we'll also add to that data on bank branches, which will match to houses by the location of the house. So if a house is located in an area with a lot of bank branches, we'll assume that that house is sort of more of an informational target, because there will be a lot of mortgage bankers around, and these guys are going to tell potential buyers and sellers, look, there's a new interest rate in town. Okay. So now let me just give you an idea of what the setup is. It's nothing fancy. It's just a sort of a pseudo event study with some added features that we have to apply because of the way the housing data comes. So think of an average year. In an average year, in the case of Canada, you have 8 announcements in a year. So that's on average about 7 weeks between each announcement. So what we're going to do is we're going to separate announcement windows, in this case in 6 weeks, sort of to allow for some room between announcements. And we're going to consider the red dots that you see over there are going to be the week 0 data. So anything before announcement, anything that was listed before announcement. And then all the blue dots are going to be the houses that were listed after the announcements. So you can do this break both by the listing date, and you can do this break also by the sale date, right? So think of houses that were sold right before the announcement and housing that was sold later. And we're going to pull all this window, and in our case, it's going to be 114 monetary policy announcements in one regression, and we're going to estimate the coefficients for each of these weeks for house prices responses to unexpected changes in the interest rate. All right. So no rocket science here. And that's the sort of how the model looks like. On the left hand side, we're going to have log prices, and on the right hand side, we're going to have two things. So we'll have this indicator variables that stand for the weeks after announcement. So depending on time t, if you're listed in a given week after announcement, we'll capture you with this indicator variable, and we'll treat you with this YAT, which will be the size of the monetary policy surprise for a given announcement A. We'll also have a bunch of housing characteristics. We'll also have some month-year dummies, and we'll have some geographical fixed effect. In this case, they're called the sort of a postcode variation in Canada is called the FSA. And this is why you should think of them as a change in zero coupon bonds from the day of the announcements compared to the day before the announcement. Okay, so let's say, and that should measure the unexpected change, right? So that's not necessarily the change in the policy rate. If everyone in the market was expecting that the central bank will increase by 0.25, then there will be YAT will be equal to 0. So there won't be there shouldn't be any reaction in prices. All right. So now I'm going to move to the results, but before that, I'll just recap what we want to do here. Is we want to measure the effects of house prices effects of interest rates on house prices. And we're doing it for a bunch of listed properties. So it's kind of like micro-ish sort of evidence on this effect. And we'll try to make sure that we'll start separating this sample by both types of brokers that facilitate these transactions, and also by types of houses and types of banks. So what you'll see next is basically a reaction in list prices and different ways to have here in the column is the reaction of list prices. And then I have the coefficient on the yield change times the weekly dummies. So as you can see already in the first week after announcement, you see a drop in list prices, and the largest drop is sort of attained in week 4. So for 1 percentage point increase in short-term rates, you would have a 10 percentage point drop in house prices. So mind you, this is a 1 percentage point increase in the unexpected interest rate. And also you should have in mind that, you know, when central banks typically increase rates or decrease rates, they do it in steps. So it's typically what you would see a median increase would be about 0.25, and a median surprise on top of that, if it's an increase, would be around 0.15 percentage points. All right. So you keep that in mind in case you wanna understand what this 10% stands for. So now, let's suppose we observe these properties for which the list prices have dropped. What we can also compute is we see the sale price for that property that suddenly came at a low price. Okay, so we can also see whether the change in list prices translates in sale prices, and indeed it does. There's some variation in terms of the magnitude of right away and sold right after the announcement. Sorry, for this property, the price adjustment is less, as if information hasn't. So that's why you don't observe such a huge drop in sale prices. But as we go into weeks after announcement, the sales prices also decrease. So what I can do is, instead of focusing on houses that were listed after announcement, I can also do the same thing for houses that were sold after announcement. So this is what I plot in this column. And as you can see, during the first 3 weeks, there is also almost no significant response, which tells me that, you know, in the weeks after announcement, if you see any house sale, it's very likely that the house has been sold at a price that is not affected by the interest rate, because there were already negotiations between buyers and sellers happening in those weeks, and those are already some sticky prices that they were negotiated on. And it's hard to convince a seller, it's hard to convince a seller to lower the price when you already committed to something, right? And interestingly, if we sort again by listing date, what you can compute is sort of the difference between the listing date and the sale date, and we call that time on market. So what happens when interest rates go up is that you would observe a drop in time on market. All right. So in a way, now that house prices are lower due to the hike in the interest rate, you would expect that properties start selling faster. All right. So what I can do next is I can focus on different time periods. So given that we have 14 years of data, we can sort of disentangle different periods during this timeline. And this is what we do here. If we look at all properties that were listed between 2001 and 2007, and that had and during the monetary policy announcement windows, you will notice that again we have significant results, and the magnitude of coefficient is actually greater than our benchmark regression. But once we move to the crisis period and to the post-crisis period, during the crisis period there's almost no significant response in house prices, and after the housing period from 2010 to 2014, it seems that we've moved into a world that, you know, interest rates don't influence things as much. And we still want to explore this more, because as in the case of both China and Ireland, there were some policy measures that were more macro pro-like than interest rate like that affected the housing market. So it seems that, because the interest rates were basically at the same level during that period, so obviously you're not going to find anything significant in terms of house prices. So if anything, it was not the interest rate channel, it might have been the LTV channel or the LTI channel. Okay. So what we do next is, because we know the the brokerages, the brokerage houses that intermediate these transactions, we can compute sort of the differential price response for transactions that are intermediated by big brokerage houses. And by big brokerage houses, we slice the data using the mean of their previous sales or of their value of their sales. So think of big brokerages being, you know, houses that have a lot of real estate agents, so supposedly, and a lot of listings, so supposedly they know more about the supply and demand in the current state of the market. And then smaller brokerage houses are the ones that know very little. So what we find here is, if you look at sort of the red numbers, is that large brokerage houses are actually the ones that intermediate transactions with the highest drop in prices, and brokerage houses below mean size, there's very little change, significant change in house prices after in the first month after the announcement, but they do seem to catch up sort of later on. It could be because of some sort of you know, information effects, that suddenly buyers and sellers of the smaller houses realize that there's something going on in the market is moving in a certain way, or whether these brokerage houses themselves, because they're smaller, they have a higher cost of learning about the state of the market. Okay. And the last thing I'm going to show you is what I'm doing here is I'm plotting exactly the same thing, but exactly the same table as before, but this time I'm doing it in, you know, in a visual manner. So I have figures for those coefficients, and this was the benchmark. And before I was using the 3-month, the change in the 3-month yield as my monetary policy shock. So these are the coefficients that you've seen over there with a minus 10% drop after 1 percentage point hike. And now what I can do is I can look at the yield curve. So at all the maturities of the yield curve, right? So because we kind of know that monetary policy affects the yield curve predominantly at the lower end. So in terms of like short-term rates, we want to see whether changes in the upper side of the yield curve. So think of like some sort of duration effect for our price changes, whether there is anything significant there. And as you can see, most of the action is at the 3-month and one year yield level. And if anything, changes in the long-term yield affect house prices positively, and that could be related to a story of if long-term growth prospects are that good, that means house prices will obviously increase in the long run, because, you know, everyone expects that the economy is going to do well. That's why the central banks are increasing interest rates. Everyone expects good GDP going forward, good incomes, so house prices are going to increase as well. Okay. So just to summarize, what we find is a fast response of list prices to unexpected changes in interest rates. It seems that the size of brokerage houses plays an important role in how prices react to changes in interest rates. What I don't show here, but what we also have in the paper, is that proximity to mortgage bankers seems to also play an important role. So we also do the same experiment with mortgage bankers as we did with brokerage houses, in the sense that we try to proxy for big mortgage bankers. And what we also find is that it's, if anything, when interest rates change, it's mostly houses in the upper quartiles of the price distribution that react to changes in interest rates during this period. And because this is very preliminary, what we're doing right now, we're adding US data with more cities, kind of comparable time period. And we're also adding the Danish data, where we observe where there is no monetary policy in the true sense of the world, because we are importing policy here from the ECB. So the Danish central bank can do very little about the interest rate. You cannot target the housing market, if you want to say so. And we also observe in Denmark the exact mortgage broker to real estate broker connection. So we know what contract was recommended to you when you visited the real estate broker. So we hope that will bring more evidence on the information channel. That's it on my side.
Great, thank you. Very interesting. So let's do some questions now. Kaiji, would you like to start?
Yeah, that's very interesting paper. I wonder whether you can see this pass through across different region, you know, or different housing market, you know, whether there's a market for the high end or for the low end, to see that if that's effect is more obvious or more significant for the low end housing market. and between before the crisis or this during the crisis or after the crisis. If after the crisis, you see that it does not, overall it does not, that's effect not that big as before. But I'm wonder whether there's regional heterogeneity in this kind of pass through. Yeah.
Yes, so I can actually answer that by clicking this, and it's a huge table. So I'll try to guide you through it. So what we do is we suppose you have a distribution of list prices at each point in time. Take the median, take houses on top of the median, housing below the median. This is not geography for now, but think of it as housing markets in segmentation in terms of price. And as you can see, most of the reaction in prices, all these negative significant coefficients are for the above the median house prices. So it's really the pricey segment of the market that reacts the most to changes in interest rates. I mean, you can cut the distribution in many ways. So here's what we do is we do the top third, middle third, and bottom. And it turns out that it's actually the top 1/3. So it's not just top median, anything above median, but anything above the top quartile, top, tercile actually. So that's an answer, but we have to do the market segmentation by geography. That's a huge thing, especially in the market of Vancouver. And that's definitely on our to-do list.
Brian, do you want?
Yeah, so I think related to that, I think it would be really cool if you could use the network of brokers, also kind of related to Kaiji's question. So are the big brokers where you see different effects, are they located in different parts of the city? And perhaps you can then see like correlations and how quick those parts of the city move to interest rates through this network structure. And there's lots of like cool network stuff that you can do actually using the network structure, but even just looking at where the places are kind of connected would be cool.
So we kind of tried that. We plotted the distribution of brokers in space. Mm-hmm. And as you would expect, it turns out that big brokers are everywhere. Okay. This is how they become big. If there is any informational spread, it's not. If there is an informational effect, it will probably not go through big brokers going into certain areas. Mm-hmm. Since I suspect that they transmit information across all their all their agencies. I don't know how it works in San Francisco, but even in Copenhagen, so that's something that I can confirm here, is that these big brokerage houses, they have representation in all the areas. Mm-hmm. Whereas smaller brokerage houses are actually the ones that target particular areas. It's typically someone who, it's a real estate broker that broke out of a brokerage house and started his own thing in areas where he used to sell or used to intermediate properties. Mm-hmm. Mm-hmm. So we should definitely explore if there is more to that, but at the first glance, it didn't look like we're going to catch much of geographical effect of informational spread.
And a second question is, have you been able to look at listings that were listed before the announcement and then where the price was updated in the listings data? Do you see updates?
We see very few of them.
Okay.
I'm hoping that in the US data we'll see more. In the Vancouver market, there is very few of it. So it's like, I think below 2% of, below, let me put it this way, below 5% of listings update during the lifetime of a listing. Okay. And then for those during announcement periods, because everyone kind of knows that, well, the brokers know that something is coming, they don't update it.
Okay.
So they kind of, you stick to whatever price you started. I think we had like something between 1% and 2% of the listings. So it's, you cannot catch much, unfortunately. Mm-hmm. Mm-hmm. But yeah, that would have been great because.
Yeah,
go ahead.
I guess also since the rates are going up, what might happen is that the prices are negotiated down between the list price and the sale price, but not necessarily that you upfront lower your list price.
Yep. That's what we find, actually. That's what we find. Obviously, it depends on the week of the announcement, but I showed you this difference between the list price and the sale price, and the effects were different. They were not one-to-one. Yeah, so that's kind of what happens. It seems that it goes through the sale price, not the second list price, if you want.
I had a question about the, so is the sales date like the closing date for the transaction, or is it like the date when kind of they agreed on the price. So
So
I
that's a
know in
very good
Denmark
question.
and in Norway they're kind of okay.
They're also different in Canada, and what the results that I'm showing you here are when at the time when the buyer and the seller shook hands and signed a commitment.
Okay.
Okay, that price can change because the buyer can investigate the property for about, it's called an escrow period. So it takes about 25 days on average in Canada. But we also observe that price. And because Canada is a nice country in the sense that everyone is kind of nice to one another, those prices, we check that just for the sake of doing it, they don't vary that much. I think we found something around 4% of properties change the price, and the median change is about 5%.
It was more about the
5%
dates.
actually.
It was, my question was more about the dates, not about the level, but if one, but okay, thank you.
Sure.
It got clarified. Okay, great. So I guess now it's my turn. Should I present myself? Okay, so I'm Plamen Nenov.
It's too.
Should you do Dennis? Dennis, would you like to?
Sure.
Okay.
Sure. We have Plamen finishing our session today, and we still don't see your screen.
No, I'll share it now.
Yeah, okay. And Plamen is going to talk about transaction sequence decisions and housing market volatility using, I'm guessing, Norwegian data.
Yes, that's right. Okay, great. Yeah, so we saw very nice papers about loan-to-income, loan-to-value ratio, the effects of monetary policy. The topic of my talk will be maybe slightly more esoteric at first, but hopefully I'm going to convince the session participants and anybody listening that this is kind of important stuff too. Okay, so there are two starting points for this paper. So first, it's a question. So housing markets, they're kind of a typical frictional asset market with decentralized trading that one thinks about. So there's like a group of models that kind of model this type of frictional trading, search model, or that use search theory to understand what the implication of these frictions are for prices. And kind of a central prediction in these models is that the what's known as the buyer to seller ratio, or also sometimes called the market tightness, it's a driver of house prices. So the channel usually is if the buyer to seller ratio goes up, it will be selling will take faster, so that raises the outside option of sellers, so they tend to then get a higher price. Okay. Or it could be that if there are more buyers relative to sellers, there are more bidding wars, and that also kind of additionally amplifies prices. Okay, but for this kind of link between tightness and prices, there's so far little empirical evidence. So our paper is going to try to contribute to kind of show some empirical evidence that tightness has an effect on prices. And how are we going to do it? So we're going to use a recent insight from like a paper of mine with Espen Moen and Florian Sneakers that kind of examines the microstructure of the housing market. And in particular, it examines the transaction sequence decisions of moving owners. Okay. So what we kind of argue in that paper, which is mostly theoretical, is that moving owners, they actively steer their transaction sequence. Okay, so what do we mean by that? So at the time when they decide to move houses, these moving owners, some of them will decide to buy first. What does that mean? They're going to buy the new property first, and then they're going to sell their old house. Okay, or they will decide to sell first. Okay, they'll sell their old house first, then they'll buy. Okay. Now, what turns out to be the case in a frictional housing market is that if more moving owners buy first, that tends to crowd the buyer side of the market. So it actually increases the buyer to seller ratio. Okay, So then, if there's a link between prices and the buyer to seller ratio, we should see prices going up. We should also see time on market going down. Okay. Now, what else we kind of we don't really explicitly show it in that paper, but we exploit it a lot in our current paper, is that there's actually an interaction effect as well. So if one considers a housing market where there are relatively more of these moving owners relative to the other type of transacting agents, then if more agents buy first, there's actually going to be a larger effect on market tightness. So then there should be a larger effect on prices. Okay. So in our paper that I'm presenting now, we're going to use this insight plus some data from Norway, which is kind of quite unique in some dimensions, as I'll mention briefly later, to basically provide evidence on the effect of tightness on prices, or more directly, it will be evidence on the effect of changes in the transaction order on prices. Okay, so what else do we do? So I mean, this is kind of just a little outline of all the different steps in the paper. So first, we're going to show some new facts about the transaction sequence of these moving owners. Then we kind of do a shift share design, which is motivated by this interaction effect that I just talked about in our previous paper. Then once we do our shift share estimation, it's going to be designed in such a way that the coefficient estimates are going to have a structural interpretation. So we're going to create a simple model and combine that simple model with these coefficient estimates to back out the elasticity of prices to tightness. Okay, and then we're also going to use this calibrated model for some counterfactual analysis. Okay, so briefly, what do we find? Okay, so the buy first share. So what is that? That's the share of moving owners that buy before selling. So they buy first. So that varies substantially over time. It also co-moves with house prices. And what we can show is that these movements are not due to some strange compositional effects due to demographics or other sort of compositional changes. So it's it changes the behavior of everybody in some sense. Okay. Okay. So now in terms of the shift share, so I had this kind of different colors here. So the shifter, and what's the shifter and what's the shock exposure? The blue is the shifter. So changes in the aggregate buy first share tend to be followed by a larger increase in prices in local housing markets that have relatively more moving owners. Okay, so this is the shock exposure. So there's also a similar negative effect on time to sell. And these effects are economically significant and they are highly robust. So we do a number of robustness checks. Okay. Now, in terms of our calibration, so we using the actual quantitative coefficient estimates from the previous bullet point. So we are able to basically back out an elasticity of prices to tightness of around 0.4. And then in our counterfactual analysis, we show that drops in the buy first propensity accounted for about 30% of drops in house prices in Oslo and Copenhagen in the financial crisis. Okay, so I skipped related literature. It's quite standard. Okay, so I'm going to be using a few terms. I already actually used a few of those, but just to kind of have everybody be on the same page, I'm going to be laying them out here again. So what's a moving owner here? This is an owner-occupier that buys and sells different properties within a year. That's what kind of how we identify them in the data. A buy first moving owner, it will be a moving owner whereby the first transaction in their sequence is a buy. So they buy the new property. The buy first share, then just a share of moving owners that have bought first in a given quarter. Now there's also this thing of within moving owners. So what is that? So since we're going to be looking at these local housing markets, so these are moving owners that buy and sell and stay within a specific location. Okay, so they're also across moving owners, right? So those buy and sell, but then they change locations. Okay, so our data, so it's transaction level data for the 4 largest cities in Norway and their surrounding municipalities over a fairly long period. So we have, hedonics and stuff like that. So what's kind of neat about the data and what makes it unique is that we have unique property and individual identifiers. So then what we can do is we can create transaction histories of individuals. We can also match, since we have individual identifiers, we can match with register data. So we can get demographic information. We can also get balance sheet information. So we have some exercises about the effects of balance sheets on the propensity to buy first. Now, some drawbacks of our data. There's this large chunk of housing in Norway and other parts of Scandinavia known as housing cooperatives. Those are only available from 2007. So, our kind of for our kind of main analysis in our shift share design, we're going to cover basically the period from the beginning of 2007 to end of 2016. Okay, we have 49 local housing markets. So basically those are large city, so neighborhoods of the large cities, plus surrounding municipalities, which treat them as kind of the whole municipality, apart from one particular surrounding municipality of Oslo, which is kind of really large, so that we also split in 4. Okay, we create hedonic price indices for each of these local markets. We then aggregate it up to have an aggregate price index, and then we also have a time to sell proxy. Okay, so unfortunately, we do not observe the list dates for these properties. We only observe the closing dates, so we can only have a time on market proxy. So what do? Is we use actually something that we did in that previous paper of ours, where we had some data for, actually it was for Copenhagen, and there we could observe, we also didn't observe the listing dates, but we had another series for time on market. So there what we showed was that actually the average time between the first buy and the second sell transactions of a buy first moving owner, it tracks time on market very closely. So we're gonna basically use that here as a proxy for time on market for the sellers. Okay, so let me show some of these new facts. So first, this is kind of the buy first share in different age bins and for different household structures. Okay, so basically there's a lot of heterogeneity in across households. So when I talk to people about this, I either meet people that say, oh, of course everybody buys first, or I meet people that say, of course everybody sells first. Okay, so it seems like there's a lot of heterogeneity. Different people do different things, and it's kind of tied to age. So younger people, whenever they transact again, they tend to sell first, or they're more likely to sell first. And then over time, there's like a life cycle pattern of increasing in the probability of buying first. Okay. Also, couples, the couples with kids, they tend to buy first across any age. Okay. So this, we interpret this as reflecting some heterogeneity in the costs associated with buying first or selling first. So what are those costs? So if you buy first, you have to have 2 mortgages. Maybe the bank doesn't let you kind of carry like such a large mortgage around. You have some limited wealth, or you're leveraged, or other sort of constraints like that. If you sell first, you might have to go into a rental, a short-term rental property, and that might be very costly for some households, particularly those with kids or older households. Okay, so this underlying cost heterogeneity makes people steer their transaction sequence. So there's clearly there's some underlying decision going on that we so interpret this as evidence that they're steering their decision. In the paper, in the appendix, we also show some correlations with balance sheet characteristics, like income, debt, and stuff like that. So part of these life cycle effects are probably due to younger households being poorer or having higher leverage. Because so it turns out that there's some negative correlation between propensity to buy first and leverage, negative correlation with positive correlation with the level of income, stuff like that. Okay. Now, okay, so there's all this heterogeneity, but then if we plot the buy first share, which is the solid line, and then if we also kind of try to partial out all these observables and plot kind of these residuals, which I call this the buy first probability, they actually co-move quite a bit. And so basically these observables, like age, household structure, the location, and stuff like that, they explain very little of the time variation in this buy first share. Okay, instead there's kind of some, some aggregate shocks that tend to kind of move this buy first share. So this is not kind of some compositional effects that drive the variation. And there's quite a bit of variation in the buy first share actually. So, we're going to be focusing on the period from 2007. So it's from somewhere here. There's the financial crisis here that one sees a drop, but it's not just the financial crisis. So there are these movements up and down. Okay, so we're actually going to be exploiting those in our shift share design. Okay, another thing I want to show is that there's a pretty high correlation between the buy first share and house price changes. Okay, now here, like the buy first share tends to lag, but the lag is around 1 to 2 quarters, which is consistent with the average time to buy. So if one were to kind of construct a fictitious buy first share as of the time when the transaction sequence decision is made, then these series will actually become moving kind of almost simultaneously. So we think this is quite interesting and again suggestive of the buy first share kind of having some important role to play in the housing market. Okay, so now I'm going to move towards the shift share analysis. Okay, so I kind of in the introduction I briefly talked about it, so I'm going to kind of show it now, and later on when I show the model it will become a little more clear why we use this particular kind of structure for the shift share. But basically, what's the kind of what's the motivation for the shift share? It's this interaction effect prediction from our theoretical paper. So basically, a housing market with relatively more moving owners relative to other transacting agents has a larger response to the same change in the propensity to buy first. Okay, so people tend to change their transaction sequence in the same way across housing markets. The effects will be larger in the housing markets where there are more moving owners. Okay, so I'll formalize this in a few slides. Now it's kind of just one has to take it as kind of this is an intuitive relationship that we're going to be exploiting. So our local shock exposure is going to be kind of capturing a measure of this kind of the share of moving owners. Now it has a particular form, again, because we're going to be using our coefficient estimates in the model later on, but it's basically kind of a ratio of the moving owners within a location to total sales. We need to also subtract them again from the denominator to get to a kind of to be able to structurally interpret our coefficient estimates, but it is roughly this. It's like how many moving owners there are within a local housing market relative to the total sales. Our shifter is going to be the best proxy for changes in the buy first propensity, which is the change in the aggregate buy first share. Okay. So our specification. So we're going to be basically estimating some dynamic responses here. So we're going to be looking at the dynamic response in prices and time to sell over different horizons. So the horizon here is denoted by H. To changes in the buy for share interacted with our shock exposure that happened at time t. Okay, then we have some. We're going to do this dynamic response estimation using local projection. So we're going to estimate for each horizon age, and then we're going to kind of assemble those estimates to construct an impulse response. We have a number of controls in our baseline specification. So what are those? So we have a number of fixed effects. So first we have fixed effects for local seasonality. So it could be that different locations have different, local seasonality. Then there's city by quarter fixed effects. So it could be that there's some city factors. So cities might be on different trends. So those would be kind of absorbed by these city by quarter fixed effects. We have 6 lags of our regressor. That's because the buy for share is actually mean reverting. So we kind of want to, control for this mean reversion in the buy for share from previous for lagged shocks. So we use 6 lags. And then we have this other control, which I'm going to kind of talk a little bit more about in the next slide, but it's basically our shock exposure times the aggregate change in prices, house prices at the estimation horizon. Okay, so this is kind of this is helping our identification claim. Okay, standard errors, they're two-way clustered, so both by time and by location. So why do we cluster by time? It's so that if there's some common shocks across locations, which there more surely are, because our locations are sometimes just neighborhoods of the same city, we do not want those to. We don't want to treat those locations separately. So we want to cluster by time. We are also going to weight by the number of households in a location. Okay. Okay. So let me just discuss identification. So identification assumption, we can write it like this. Okay. So it's kind of a exogeneity condition. So so what is this? So here, we've grouped our local unobserved components, the U's, but we weight them by the shock exposure to create kind of a another error term at the kind of that has like a time, it's just time varying. Okay, so basically this error term is going to put more weight on high kappa location, on shocks in high kappa locations. Now what's the idea here? So why am I writing it like this? It's like, well, it's like if the buy for share goes up, it could be that there's another aggregate variable that also goes up with the buy for share, and that other aggregate variable, similarly to the buy for share, affects high kappa markets more than low kappa markets. Okay, now in that case, our identifying assumption will be violated. So so this is kind of like this rescaling of these disturbances. It kind of captures this idea that we don't want, for our identifying assumption to hold, it must be that other aggregate variables that correlate with the buy for share do not affect differentially the high kappa locations more than the low kappa locations. So we do not require random assignment of kappas, but we require this, that there's no this differential loading of other aggregate variables. Okay, now what could go wrong? Well, it could be that there are other shocks that correlate with changes in the buy for share and do load more on high kappa locations. So it could be that there's some shocks that increase the demand for housing, and our high kappa locations are actually the ones that kind of where this demand increases even more. Okay. Now, what we're going to do is, well, we're going to think that if these shocks, these other confounding shocks, are relevant for housing market dynamics, they should also impact aggregate house prices. Okay. So then basically, if there's a problem, these high kappa markets, they should also be markets that are more sensitive to the aggregate housing cycle. And that doesn't seem to be the case. So this is just a scatter plot plotting, the beta of a location against its kappa. It doesn't seem to be a very strong correlation at all. Okay. even though, you know, there's no correlation, we still, what we do is we basically allow for an arbitrary correlation between the kappa and the sensitivity of the local market to the aggregate housing cycle by basically using kappa as the loading variable on changes in aggregate house prices. Okay, so this is kind of a really hardcore control. But the idea is this, that, you know, these confounding shocks, they must affect aggregate house prices. If they don't, if they still affect local house prices but not aggregate house prices, then we might be in trouble. We do some robustnesses, but yes, it could be a problem. Okay, there's a second threat that's reverse causality, but we think we're kind of quite safe on this, so I'll skip it. Okay, so here are our baseline results. So what is this? So we've normalized here the kappas to their relative to their standard deviation, just for ease of interpretation. And so how do we interpret this? So a 1 percentage point increase in the buys per share is associated with a 0.5% faster house price growth in locations that have a kappa that's 1 standard deviation higher. Okay. Now what's interesting is that kind of this effect is kind of sluggish. It takes a few quarters for it to pick up. The same effect is on time on the time to sell. Here the effect is negative. Around Q2 here, you know, the estimated effect is around 1%. So again, a 1 percentage point increase in the buy per share decreases time to sell by around 1% more in a location that has a kappa that's 1 standard deviation higher. Okay, our pre-trends, they seem to be quite flat, and there's also this kind of hump-shaped response. So we interpret this as due to the fact that the buy per share itself is mean reverting. So we're basically also getting a mean reverting outcome. Okay, so we do a number of robustness, and I'm kind of short on time, so I'm going to skip these. But things seem to be quite robust, so we do quite a few things. Okay, I want to consult the paper to see what we do. So in terms of the calibration, so okay, so this is a kind of a toy model of the model from our theoretical paper. There's not going to be an explicit buy first or sell first decision. We're just going to focus on the stock flow process in the market. We're going to segment the market in a number of local housing markets that we index by I. So what is kind of important here? Well, so what happens in each market is that, you know, their homeowners, each and it's a continuous time model, so they get hit by these mismatch shocks that come at rate gamma, at which point they want to move within the same location. And how do they do the moving? Well, they buy first with probability xi. Okay. In addition to these moving owners, there's also just other agents that transact. So they kind of come in and out of the market at rate G. Okay, so here, so what's the kind of, what's to remember is the gamma, the G, and the X. Okay, there's frictional search given by constant returns to scale matching function. So there's a market tightness theta that controls the time to sell, and it also kind of affects house prices. Okay, so we're going to assume that the local probability to buy first is a function of like a bunch of aggregate shocks in addition to kind of little local variables. Okay, and these aggregate shocks, we're going to assume that they're kind of also affecting the aggregate buy first share. So then if we kind of invert it, if we do some inversion, we can kind of have the aggregate buy first share proxy for these whatever number of aggregate shocks that move local buy first propensity in all locations. Okay. And what do we, you know, we do some tricks that we learned from our long theoretical work on this. That is that one can do what we call a small flows approximation. Basically, we take both gamma and G, so the arrival of these transacting agents goes to 0, but their ratio actually stays fixed, and that's this kappa that we have in the empirical part. Okay, and there's kind of a one-to-one relationship between this theoretical kappa and the kappa we constructed in the data. Now what this implies is that the market tightness then has this kind of very simple structure where it's kind of it depends on kappa times the probability of buying first. Okay, and what one can show is that actually, so market tightness increases in X in the probability of buying first, but this increase is actually larger if kappa is higher. So this interaction effect that I mentioned already in the introduction. So this is the interaction effect. So changes in market tightness due to changes in the buy for share are higher when kappa is higher. Okay, and then we can derive the price effects and the time to sell effects. Those all are indirect effects due to changes in tightness, and they're the structure is that there's some elasticity of the price with respect to tightness, or of the matching function with respect to buyers in this case, times the effect of tightness due to changes in the buy for share. Okay, so then these are the kind of the partial effects. So there's also kind of an equilibrium effect that one needs to take into account. And given that the structure of a regressor was this, then one can derive the exact form of the regression coefficients that we had in our empirical analysis, and they take this form. So it's basically for the price effect, it's the elasticity of prices to tightness times a multiplier, and then also for the time on market. So what do we do with these things? We don't know what these multipliers are. Well, what we can do is we could just take the ratio of these two coefficients, and if we have some knowledge of the elasticity of the matching function with respect to buyers, then we can back out the elasticity of prices with respect to tightness. And luckily, we have that knowledge from other papers. So we just plug in our coefficient estimates from what we just did, our shift chair exercise, and I estimate from the literature on the matching and the elasticity of the matching function with respect to buyers, and we arrive at our elasticity of price with respect to tightness of around 0.43. Okay, so then we also do a counterfactual exercise, which I'll just very briefly mention the results from. So we kind of take one city, say Oslo, it has a kappa of 0.3, and we do some assumptions on kind of how the buy for share responds at the city level. Basically, we assume that there's no feedback effect, so no multiplier effects of any sort. So this, in some sense, is kind of a lower bound on the effects. And then we just look at what happened in the financial crisis in Oslo and in Copenhagen, which is places where we have data for. So the buy for share decreased by around 10 percentage points in Oslo. It decreased by around 30 percentage points in Copenhagen around the same time. So those correspond to, around a third of the decline in prices in each place. Okay, so I'm out of time. So very briefly, so we do, we've shown you empirical evidence that the transaction order matters for housing markets, and we also show evidence that tightness affects prices. Okay, thanks. Oh, can take some questions.
Yeah, this is very interesting finding, and I have one comment. So my intuition is that if you buy first, you tend to, especially in the good time, you tend to upsize your house, right? If you sell first, you tend to, downsize your house. For example, if you're a good income shock, you want to buy, a house, so you want to, buy. So the buy first share, I wonder whether there's any linkage between the fraction of the household who are upsiding their house, versus the fraction of who downsizing house, right? Yeah, I wonder if the data, can you see if there are linkage between these two? Because, my question is that if more households who are upsiding their house, that could also imply an increase in housing demand, then that's gonna trigger increase in housing price. So of course, that's related to buy first share, but I would, like to know how you can just identify your channel versus the other channel. Yeah.
Oh, that's a very good question. So first, I guess the upsizing versus downsizing, that's also kind of, there's an age pattern there, right? So older people, they tend to downsize. Younger people, they tend to upsize. But, it seems like, at least kind of in the cross section of households, whether they upsize or downsize, it's probably not that correlated with whether they buy first or sell first. But this is kind of in the cross section. Maybe over time there's a different pattern, so which we haven't really looked at. So we should check. I know our hunch was that since we kind of try to kind of have these hedonic price indices that should be purging the compositional effects of the different houses being transacted, and these kind of what types of houses are getting transacted at what time should not be that influential. We also did a robustness check where rather than looking at the aggregate house price, we kind of created 3 different house price series. One was for kind of like any types of house, like single family, semi-detached row house. Then there was a small apartment series, and then there was a large apartment series, so 3 different series. And then we used those as the kind of the shift share controls. And this is this robustness. So one doesn't see that much going on there either. So so I guess it's, yeah. I mean, this is the best kind of answer I could give to this, that it seems like it's not kind of the composition of houses being transacted over time that correlates with the aggregate buy for share that's driving things. But that's as good as we can do, of course. So, yeah. Okay, but thank you.
Well, I had a question about iBuyers in this market. So we've seen these kind of come into the US in places where they're willing to be the intermediary between buyers and sellers. Have you thought about that much? And in particular, can you compute in your model how they would affect kind of the volatility? And in particular, maybe you can compute how much profit they would be able to make off this.
Oh, yeah, no, that's great. That's a great question. So yeah, I mean, it's clearly there's some sort of arbitrage opportunities here if one takes this literally, right? So now what could be happening is that there could be already some people trying to arbitrage this, even just regular people. They see that temporarily there's kind of some imbalance in some neighborhood, and they're like, man, this neighborhood is now too expensive relative to what it's offering. I'm gonna stop buying, I'm gonna not try to buy there. So that should be kind of already in our empirical estimates, and we do not have it in our model. And then in some sense we're saying that market tightness, market tightness probably in truth responded less than what we're saying in our model because of these arbitraging people. Okay, so in that sense, it's kind of, we're understating the effects. Okay, but not exactly also these effects tend to be kind of short-lived, right? So you see these kind of hump-shaped things, because the buy for share kind of, for whatever reason, it drops for a couple of quarters, then it recovers. So let me just show you what it tends to kind of do in terms of dynamics. Okay, so this is the kind of dynamic, the solid line is the dynamics of the buy for share. Okay, so it's kind of, this is at quarter 0, this kind of just correlations, dynamic correlations, okay? So it kind of just immediately starts reverting back. So then by 6 quarters, it's back to where it started. So it's not a very long-lived shock. So then these guys, maybe there's just not that much time to start arbitraging these things. So yeah, but also I'm not, so I don't know how much, when they started. So when is that, like a recent phenomenon in the US, I guess? Or?
So yeah, it's pretty recent. As far as I know, it's the last few years. I know Amit Saru has a new paper. I haven't read it, but it's just released, and so that might be useful to see data on what's happening.
Yeah. Okay. We'll check that. I mean, there's clearly some arbitraging going on that we're kind of swiping under the rug here. So, but we're thinking it's kind of where it's going in our favor in some sense. So
yeah.
Okay.
Yeah, I think in the US, I think Zillow is starting to get really into it. So they're like the biggest website, and now they're trying to be one of the biggest intermediaries.
I see. I mean, there's clearly money to be made. So yes. Okay. And Dennis?
Plamen, I just have one clarifying question.
Yes.
And you can, I would ask you to elaborate a bit on the reverse causality part, because it seems that precisely because of money to be made, it seems that if house prices go up, it's actually optimal to buy first, right? Because you're expecting that you're going to sell at a higher price. So it's there's a monetary
Yeah.
gain in this. So I'm thinking
Yes.
maybe it doesn't go from this share of buy first to house prices, but from house prices to share of buy first.
Yes. Yes. That's I'm actually going to put that into thread 1. So what you're saying is that buy first share might be a forward indicator of future changes in house prices, right? Because if these guys are forward looking, they should be buying first now and then riding the increase in prices. So basically what's going on is that there's an underlying aggregate shock that loads more on these high kappa locations, and the buy first share change today is just kind of a forward indicator for this shock change in expectations or whatever. So I mean, again, it's kind of the response is that what we can do is we can use variation in the buy first share that's kind of orthogonal from the variation in aggregate house prices, even at the estimation horizon. So there kind of a buy first share moves for other reasons, I guess, that do not get impounded in house prices, and so our estimation uses that variation. But yeah, that's clearly a concern. That's clearly a concern. Yes. Yeah, so we do this thing with the aggregate house price shift share as a control. We've tried other shift shares controls as well, but it seems like the aggregate house price was the one that was kind of giving us the most trouble. So that's what we kind of put in as the baseline. But again, yeah, there are other shocks. Of course, it's kind of a black box here. What drives the buy first share? So we're not kind of saying that this is it. It's more like evidence, right? Yeah. Okay, great. Okay, so I think we are now done. So thank you, Brian, Kaiji, and Dennis for presenting. I thought we did a great job. So I'm going to now stop the recording. Okay. Oh.